March 26, 2021. In roughly 48 hours, one man's fortune collapses by an estimated $20 billion. That's not a country, not a bank. One guy, trading out of his New York apartment. Almost nobody outside Wall Street had heard his name. Bill Hwang. Here's what should worry you. None of the banks that lost billions saw this coming. Not because they weren't sophisticated, but because the system was built legally so they couldn't. 9 of the world's biggest banks were all staring at the same man. Not one of them could see the whole picture. In 1 week, more than $100 billion in stock value simply vanishes, and the man responsible had already been convicted of fraud 9 years earlier. So the real question isn't, how did Bill Hwang do this? It's, how was it legal for him to do it again? This isn't really a story about one reckless trader. It's a story about a loophole, a gap in financial regulations so wide that a $36 billion fortune could be built almost entirely in the dark. And that loophole is still open today. To understand how this happened, we have to go back further than 2021, to a young fund manager trained under one of the most legendary investors on Wall Street, who was already, quietly, breaking the rules. Bill Hwang is one of the so-called Tiger Cubs, protégés of legendary investor Julian Robertson, trained inside one of the most successful hedge funds in history. Robertson personally seeds Hwang's own fund. On paper, this is the pedigree of a golden boy. In practice, it's about to go very wrong. By 2012, Hwang's fund, Tiger Asia Management, pleads guilty to wire fraud, insider trading in Chinese bank stocks. He pays $44 million to settle the case and gets banned from trading in Hong Kong. On Wall Street, that should be a career-ending scandal. It isn't. 1 year later, Hwang reopens shop under a new name, Archegos Capital Management. Same money, same strategy, new label. And that label is the whole trick, because Archegos isn't registered as a hedge fund. It's registered as a family office. A family office manages one family's own money, not outside investors, so under the law, it doesn't have to register with regulators or disclose its holdings. Some banks even blacklist Hwang at first over his fraud record. They let him back in anyway, because his trading generates enormous fees. Then March 2020, COVID crashes the market. From his Manhattan apartment, Hwang starts building enormous, concentrated bets on a small handful of stocks, media companies, Chinese tech names. He isn't buying the market, he's making a few massive, all-or-nothing wagers. In about a year, Archegos' equity explodes, from roughly $1.5 billion to $36 billion. Almost none of that growth is Hwang's own cash. It's borrowed, and it's about to get borrowed on a scale nobody outside his inner circle understands. Here's the mechanism that makes all of this possible. The total return swap. Instead of buying stock directly, Hwang pays a bank a fee. The bank buys the real shares and holds them. If the stock rises, the bank pays him the gain. If it falls, he pays the loss. The critical detail: Hwang never legally owns the stock, so none of the disclosure rules that normally apply to big shareholders ever trigger. And because he spreads this across 9 different banks, each one only sees its own slice. Nobody sees the whole picture, including the banks holding it. When the SEC later reconstructs the numbers, the scale is staggering. Through swaps alone, Archegos effectively controls over 70% of one company's shares. GSX Techedu, 60% of Discovery, 50% of IKIYI. Positions that size normally require public filings. Archegos never files a single one. By early 2021, Archegos' own equity sits around $36 billion. Its total stock exposure, through swaps, $160 billion. That's nearly 5 times leverage, all riding on a handful of stocks. In trading, that combination has a name: a house of cards. ViacomCBS, one of Hwang's biggest bets, announces it's selling $3 billion of new stock. The share price drops. It's a normal, almost boring corporate move. For Archegos, It's the first domino. As the stock falls, the banks holding those shares as collateral do what banks always do. They issue margin calls, demanding more cash to cover the shrinking value. Archegos can't pay, not because it doesn't want to, but because there isn't enough cash to cover a $160 billion bet. The weekend of March 26th, the banks call an emergency meeting, and for the first time, they start comparing notes. That's the moment it becomes clear. This isn't one bank's exposure to one client. It's 9 banks, all exposed to the same collapsing position, all at once. Here's where it gets genuinely controversial. 2 banks, Goldman Sachs and Morgan Stanley, quietly start dumping their shares before the rest of the group even finishes comparing notes. It's legal. It's also exactly the kind of first-mover advantage that leaves everyone else holding the losses. Credit Suisse and Nomura are slower to move. By the time they start selling, prices are already in freefall. They end up holding the losses that the faster banks had already avoided. When the dust settles, more than $100 billion in market value is gone. Credit Suisse alone loses $5.5 billion. Nomura loses close to $3 billion. Total losses across the banking system, over $10 billion, in under a week. That $5.5 billion hole at Credit Suisse never really heals. 2 years later, in 2023, Credit Suisse, a 167-year-old institution, collapses and gets absorbed by UBS in an emergency rescue. Archegos didn't kill Credit Suisse alone, but it's one of the dominoes. April 2022, federal prosecutors indict Bill Hwang and his chief financial officer, Patrick Halligan. The charges: racketeering, securities fraud, wire fraud, market manipulation. This time, there's no quiet settlement. Prosecutors want a trial. Hwang's own former head trader and chief risk officer take the stand against him. In July 2024, a jury convicts him on 10 of 11 counts. His co-defendant, Halligan, is convicted on 3. November 2024, Judge Alvin Hellerstein sentences Hwang to 18 years in prison, comparing the scale of his fraud to FTX founder Sam Bankman-Fried's. He's ordered to pay more than $9 billion in restitution, money that, at this point, mostly no longer exists. 2 months later, Halligan gets 8 years, less than half of Hwang's sentence. The judge calls Hwang the driving force behind the fraud, which raises an uncomfortable question for every trading desk on Wall Street. How far down the chain of command does real accountability actually go? Here's the part almost nobody talks about. The core loophole that let this happen is still open. Family offices are still exempt from registering as investment advisors. Regulators added new disclosure rules for large swap positions, but the exemption itself, untouched. So ask yourself the uncomfortable question this story is really about. How many other Bill Hwangs are quietly building $100 billion positions right now, completely invisible to the banks lending them the money, and to you, holding the other side of the trade without even knowing it? Bill Hwang is in prison now. The banks rebuilt their balance sheets. The market moved on. But the mechanism that built Archegos, hidden leverage, invisible ownership, and a regulator that still can't see the whole board, that mechanism is still legal. Somewhere, right now, it's probably already running.